The most critical documents from the Federal Reserve, which will dictate what markets do for the next 3 months, are about to be released. But in order to actually realize the magnitude of what we're about to get, you've got to go back just a little bit. And when I show you this, you're going to laugh. Or at least you should. Maybe you'll even cry. Hey everyone, Meet Kevin here. This, folks, is known as a summary of economic projections. It looks fancy and complicated, but let me show you how simple and wrong this particular document was. This document released December 15th. This, by the way, was when the Federal Reserve U-turned. This was what I called the most disastrous Fed meeting ever. In fact, if you type into YouTube, Meet Kevin Worst Fed Report, you'll actually see me react to the minutes of that meeting. But don't worry, that meeting may have been a very critical and disastrous meeting. But take a look at what you're gonna laugh at here. The Federal Reserve, at the end of 2021, told us that they expected that by the end of 2022, the Federal Reserve's interest rate level would be the following, highlighted in green on screen here. Yes, I kid you not, the Federal Reserve thought that by the end of 2022, the Fed funds rate, which I joke and call the F rate, would be 0.9%. Folks, currently, at the time of this recording, it is 2.5%. We're not at the end of 2022. By the end of 2022, it is expected to be 3.5 to 4% instead of 2.5%. Off only by a magnitude of 3 to 4x. That's pretty embarrassing. Not only did we horribly miss the 2022 projection, but we basically doubled the projection for 2024 when the Fed said we might go to 2.1%. Now this is really, really important because we're about to get one of these again. And what I want you to know is the Fed's probably going to be wrong again. Everything's going to take longer and be more painful than expected. Now we're going to talk about the June report, and then we're going to talk about expectations for the report that's coming out Wednesday. That's right, in 2 days, we're going to get a new report that is going to probably lie to us for the next 3 months. But it's going to be a really critical baseline. Now, keep in mind, it is very, very difficult to know exactly how long this pain is going to last. We just know we have to go through the pain and have to go through the mud. I've said I believe that 2022 is going to be a very painful year, and I really don't expect that to end until we really meaningfully see inflation drop, which might not happen until later this year or even next year. So buckle up. The pain is real. But at least within pain come opportunities, like your opportunity to get into real estate investing or getting deals in stocks that could survive the earnings recession. If you want to learn more about exactly what I'm doing with my portfolio, my trades, when I'm buying real estate, where I'm thinking about buying, the fundamental analysis that I do, consider checking out the programs and building your wealth link down below. We've got a coupon code expiring for those programs at the end of the month. All right, let's get into the June report. This is the June report, folks. In the June report, the Federal Reserve suggested that by the end of 2022, we would be at 3.4%. We're going to exceed that. At least this one's not off by such an order of magnitude, but we're very likely going to exceed that. Now, what's crazy though, is the Fed actually included a U-turn in their path here. In 2024, they suggested that rates would go down to 3.4% and that they would peak right here in 2023. That's the suggestion. And this gave markets reason for optimism that, okay, the tightening cycle would be temporary, we'll tighten into 2023, and then we'll U-turn. And that's exactly what markets priced in, is we would hit some form of a peak and then we would U-turn. Now, presently, that peak is believed to be about 4% to 4.5%. However, some folks are now estimating that the peak could be as high as 5%. And there are going to be some really critical pieces of data that we're going to get in 2 days. And here's what you want to be prepared for. The Fed funds rate range, this item right here, gives you the range of how high market participants, of how high Federal Reserve board members think the Federal Reserve might have to hike rates. The higher the upper end of this range, the more fear and drama we're likely to experience in the market. We also want to take a look at what the expectation obviously ends up being for the median approach, the survey, the average survey of all of the board members. Are we going to end up seeing something like the following? End of 2022, 4.2%. Wouldn't surprise me. End of 2023, wouldn't surprise me to see something that matches the prior year. I think the Fed wants to get rid of this impression that, oh yeah, we're definitely going to lower rates in 2023, but we're going to raise them now and stay higher for longer. It's even possible we could get like a shock approach and see something like a 4.6, a 4.6, and then to send the signal that we're going to stay higher for longer, something like 4.5, right? Like some really subtle minor U-turn. Now, these are the averages that we'll get from the board members, so they'd really have to conspire together to vote in such a way to bring the numbers in like this. But it wouldn't surprise me because right now markets are so enthusiastic about this U-turn right here. And that makes folks excited that, oh, the Fed paint's only temporary. But as we've seen from the December numbers and these June numbers, the Fed is probably likely continuing to underestimate the actual pain that we're seeing. Now, hopefully not. Hopefully inflation plummets off a cliff. But between now and when inflation actually starts plummeting, it's going to be some pain. Another thing is that somehow the Federal Reserve thought that they could stamp out the inflation in the markets without a meaningful rise in unemployment. Take a look at this. In 2022, they thought we would end with 3.7% in unemployment. That might end up being true, but they thought that unemployment would only go up to about 3.9 or 4.1% in the longer run. We might actually see some substantial revisions here to something where maybe the unemployment rate actually goes up to 5% and maybe even 6% in the longer term. Now, this is going to be a very politically charged hot button here because this or these sorts of numbers will be the first time that we have a SEP right before an election during the Biden administration. Keep in mind, we will not get another summary of economic projections until the election happens, midterm elections. That means whatever this document says for the unemployment rate is going to have political implications, at least in my expectations. Now, we've been talking about this idea of a paper recession since January, and one of the unfortunate things that comes out of a paper recession is additional fear. When people have more fear, they generally constrain their own spending. Now, we're really getting mixed reads on this now, so we're not crystal clear as to what our individual consumers will be doing in response to this recessionary environment that we're in. But I'll tell you something that's really incredible. It used to be that as recently as a month ago, when I would run into people, they'd say, oh, back in the recession, I did, whatever. Or something happened. Oh, yeah, back when we were on lockdown in the recession, I did this, that. Now, I'm catching people literally do one of these. They're like, oh, yeah, back in the recession. Back during the lockdowns. Think about what the implication of that is. What they're saying is, oh, I used to define the COVID lockdowns as coinciding with a recession, but now we're over COVID lockdowns and we're having another recession. So being able to use the timing of the word recession ain't any good anymore because that could refer to two different recent time frames. In these discussions, context tells us that they're generally not talking about 2008. But it's really remarkable because we're starting to say that. And as that spreads and becomes ubiquitous to consumers, there is entirely the potential for true fear to still come to markets as we enter an earnings recession. And this is where I say it's time to bunker down and make sure that you are allocated to what are potentially going to be your most earnings recession-proof stocks. one of the favorites that I have, obviously, is Tesla. Now, I will expect to be selling some Tesla in order to fund House Hack. This isn't a solicitation. Go to househack.com to learn more about that. But that is for a startup, and that is separate. And I think we've still got a couple quarters of earnings to go before we really get to sort of peak Tesla pricing, which, in my opinion, will be a very insulative stock. But I could be entirely wrong. The point, though, is that we'll be entering this earnings recession under the weight of the Federal Reserve hopefully finally being a little bit more honest with us. Are they going to tell us a realistic path of this federal funds rate? And how high is that going to go? Is there going to be someone that suggests raising the Fed funds rate to 6% or 5.5%? And what kind of response is the market going to have to that? I'll tell you, it's not going to be good. In addition to that, how high do they actually think inflation is going to go? They've been wrong every single time they've done one of these before. They thought so far that inflation would go down to 5.2% by the end of 2022. I don't know. I mean, I suppose it could still happen, but we'll see. So far, the unemployment rate has not ticked up, so they've been accurate on this. But with that technical recession, these GDP numbers look awfully generous. So what happens next? Well, what happens next is we get the new version of this summary of economic projections Wednesday when the Federal Reserve has their FOMC meeting. What you're going to want to do is come to the channel at 11 a.m. Pacific time on Wednesday, the 21st, which is when we will be receiving this document along with the Federal Reserve's rate hike decision. The Federal Reserve is widely expected to raise rates by 0.75%. That would bring us to a low end of 3.25%. However, we have fears being priced into the market that the Fed is going to give us 100 basis point hikes. Now, if we do get a 75, I do think that there could be a temporary rally in the market, because usually when the Fed chooses the lower end, the market tends to rally a little bit, going, well, it's just not that bad. Until, of course, the Federal Reserve comes out and says, oh no, it is that bad, and we need to talk down the markets and talk down the wealth effect. I think the biggest driver of the wealth effect, and this is potentially why we have an 81% chance of a 75 basis point hike right now versus a 19% chance of a 100 basis point or a full percentage point hike. I think the biggest driver of the wealth effect will not end up being stocks, it will end up being real estate. And there's a reason I sold all of my real estate in Q1 and Q2 of this year. Well, I shouldn't say all of it, about 85% of it. It's nearly all, it's a lot, but I want to clarify that. It's about 85% of my real estate to prepare for what I think are going to be the most remarkable opportunities to build wealth in real estate in 2023, 2024, even 2025. And that's why we're building House Hack, and we invite you to join, especially if you're an accredited investor. If you are not accredited, stay tuned for probably January to March. Anyway, thank you so much for watching. Make sure to go to metkevin.com/join to take advantage of the expiring coupon code. The prices will be going up again. Thanks. Bye.